Here's another example of how, to just piggyback on the last video, how the foreign currency exchange rate markets can fluctuate based on other markets besides goods and services. Let's assume for a moment there's a benchmark interest rate where, in the United States, the Federal Reserve sets that overnight rate with the Federal Open Market Committee meetings they have about every quarter. It just so happens that 3% is the interest rate, the benchmark interest rate in both the EU and the US. Now, a disclaimer here, full disclosure. You'll notice that in the goods and services example, I used this exchange rate, but we're going to forget about that one for now. What I've done is taken, again, the reciprocal, and now we're looking at the foreign exchange rate market for euros to dollars. So if we are measuring this in USD to euros, $1 US gets us 0.83 euros. Now let's say, for instance, the interest rates in the US increase. Interest rates US, they go up. And let's say they go up by 2 points. Let's call it now, it's going to be 5%. And it's a global economy. Some interest rates are going to go up. So maybe the EU interest rate went up, say, 3.2%, right? So what do we have? Well, we have a lot of euros. We have a lot of dollars. We'll just pretend here this is our little bank of all the euros that folks who live in the European Union have, and these are all the US dollars that folks in the United States have. But something interesting here, the United States benchmark rate now is 5%. 5% versus the EU, which is 3.2. Before this interest rate fluctuation, the interest rates were the same. But now we're going to have sort of a bit of an opposite effect, even though the curves are going to move the same direction, because, again, I took the inverse of these axes. So if I'm sitting on euros in the European Union and I invest those euros into, say, like a treasury bill or a bond, I'm going to get some type of 3.2% rate of return. In the US, you're getting a 5% rate of return. So if I'm sitting in the European Union with all these euros, I'm saying I would much rather earn 5% on my money than this paltry 3.2%. So what happens? The demand, obviously, for US dollars with euros will increase. Euros will dump in. Try that again. Euros will dump into the foreign exchange rate market as it pertains to euros and dollars. Will dump into that market because of the increased demand. The increased demand for US dollars. Because if you want to earn that 5% that the US is offering compared to just the 3.2 the European Union is offering, you're going to need dollars to earn that 5%. This won't happen. Euros to this 5%, that's not possible. You have to exchange your euros for dollars. So the demand for US dollars has increased. It has shifted out. The demand curve for US dollars shifts out, and with all of these euros being flooded into the FXR for euros to dollars, that's going to send a bit of a supply shock into that FXR market, specifically for dollars and euros, and shift our supply curve. Try that again. Ultimately shifting the demand curve out. Sorry, I'm going to go back to my actual pen here, and then causing a bit of a supply shock to the dollars that are already in the market, shifting our supply curve inward here. We come back to our equilibrium quantity, given that supply shock, the increase in demand for US dollars and the decrease in the supply of US dollars because of all the euros flooding this particular FXR market. So now we have a higher price for US dollars and euros. Perhaps maybe it's almost 1 to 1. Why don't we say it's like $1.02? And when I say $1.02, what does that mean? Well, that means 1 US dollar will get you $1.02 in euros. Point being is that the price, the exchange rate, because of the increase in interest rates and the demand for dollars to take advantage of that rate of return, pushed the price, the exchange rate, of US dollars to euros upwards. So here, the US dollar appreciated or strengthened, and the euro depreciated, weakened. And eventually markets will correct, and exchange rates can fluctuate as they do all the time. They actually change in real time, frankly. But this is another example to go along with the goods and services market as to how or why a demand for a certain currency would increase or decrease. And in this particular example, it would increase because abroad you get a higher rate of return for your money than you do with your currency, your domestic currency at home. I hope that makes sense. Please drop me a comment, hit the like button, or send me an email, whatever you got to do to let me know if any of this doesn't make sense. Ask me any questions, shoot me an email. And as always, please let me know if you spot an error or something that doesn't make sense so I can go back and make any corrections as needed. But so far, I think this looks pretty good. Again, if you have any questions, reach out. I'm happy to help. Until the next video, take care of yourselves and cheers.